December 10th, 2025. Silver trading at $61.05 per ounce. That's an all-time high, surpassing the 1980 peak that stood for 45 years. But here's what most people missed while watching the price surge. JPMorgan reportedly holds approximately 169 million ounces in COMEX vaults alone, representing roughly 40% of total COMEX inventories. And broader analyst estimates, tracking their activity over 14 years, suggest total holdings between 6 and 75 million and potentially over 1 billion ounces across all locations. Let me put that in perspective. Global annual mine production sits at roughly 820 million ounces. One bank may be holding more than an entire year of global mining output. If the estimates are accurate, that's approximately 9% of all above-ground investment silver supply. Gone from the market, locked in vaults, controlled by one institution. This isn't speculation, this is a pattern documented over 14 years, starting in 2011 when JPMorgan opened their first COMEX vault. And what makes this story extraordinary is that this accumulation happened while the bank was being investigated, charged, and ultimately fined $920 million for manipulating precious metals markets. They paid the fine, admitted wrongdoing, and kept accumulating. So let me show you exactly what happened, why the timeline matters, and why this accumulation might be the most important signal in silver markets right now. March 2011. Silver was exploding from $18 in September 2010 to nearly $50 by April 2011. According to market data from that period, JPMorgan appeared heavily short through COMEX futures. When prices spiked, those positions lost value. The pressure was building. Then something unusual happened. JPMorgan's application to open a COMEX silver vault was fast-tracked and approved. By June 2011, their vault was operational. They started with just 750,161 ounces, all classified as eligible, meaning stored but not available for delivery against futures contracts. But what happened next reveals the strategy. JPMorgan began stopping delivery contracts. When COMEX futures expire, holders can demand physical delivery. Most don't. But JPMorgan started taking delivery, thousands of contracts, accumulating physical metal. According to industry analysis, between 2015 and 2017 alone, JPMorgan's house account stopped 15,788 contracts. Each contract represents 5,000 ounces. That's 78 million ounces in just 3 years. This wasn't market making for clients. This was proprietary accumulation for JPMorgan's own account. By 2018, JPMorgan's COMEX vault held over 160 million ounces, more than 50% of total COMEX inventories at the time. One bank, one vault, controlling half the physical silver backing the world's largest silver futures market. But COMEX isn't the full picture. JPMorgan also serves as custodian for SLV, the largest silver ETF. According to public filings, SLV holds approximately 103 million ounces stored in JPMorgan's London vaults. That's separate from COMEX holdings. Conservative figures using only publicly reported data put JPMorgan's holdings at 272 million ounces minimum. That's 169 million in COMEX vaults, plus 103 million as SLV custodian. But analysts who've tracked delivery patterns and vault activity for years estimate 675 million to potentially over 1 billion ounces when accounting for all vaults and locations. Global above-ground silver available for investment, excluding industrial stocks and jewelry, is estimated at 7 to 8 billion ounces. If JPMorgan holds 675 million ounces, that's roughly 9% of global supply. If they hold closer to 1 billion ounces, that approaches 13%. Now, here's where the timing becomes critical. In September 2020, JPMorgan agreed to pay $920 million to settle charges brought by the CFTC, SEC, and Department of Justice. The charges? Spoofing precious metals markets for at least 8 years, from 2008 to 2016. Spoofing means placing large orders with no intention of executing them, creating false signals to manipulate prices. According to the CFTC order, 15 JPMorgan traders executed hundreds of thousands of deceptive trades. The settlement included criminal charges under RICO statutes, laws typically used for organized crime. 2 traders pleaded guilty. In 2022, Michael Nowak, former head of JPMorgan's precious metals desk, and another trader were convicted of fraud and spoofing. Here's the part rarely discussed. During those same years when traders were manipulating prices through spoofing, JPMorgan was simultaneously accumulating massive physical holdings. They were pushing prices down with paper while buying physical metal at suppressed prices. And remarkably, throughout the investigation, settlement, and criminal convictions, JPMorgan continued accumulating. The vault holdings kept growing. As of late 2025, they hold approximately 169 million ounces in COMEX vaults, roughly 40% of total COMEX inventories. That's 14 years of sustained accumulation. Now let's talk about what's happening in silver markets right now, because this is where JPMorgan's position becomes significant. Silver hit $61.05 on December 10th, 2025, briefly touching above $61.60. That's up more than $30 over the past 12 months, representing over 100% year-to-date gains according to market reports. The strongest annual performance since 1980. The price surge is happening against severe supply tightness. COMEX registered silver, meaning metal available for delivery against futures contracts, dropped dramatically. In late November 2025, registered inventories stood at approximately 113 million ounces. Then, in early December, over 60% of registered silver was claimed through delivery demands. According to market reports, on first notice day, November 28th, buyers demanded delivery on 7,330 contracts. By December 1st, another 975 contracts. With each contract representing 5,000 ounces, that's 41.5 million ounces demanded, an extremely high figure. Silver lease rates, which measure the cost to borrow physical metal, spiked to 30% annualized in October 2025. That's not normal market behavior, that's scarcity pricing. When participants are willing to pay 30% interest just to borrow silver for short periods, it signals desperate shortage. Industrial demand continues hitting records. In 2024, industrial fabrication reached 680 million ounces, the fourth consecutive year of record consumption. Solar panels, electric vehicles, electronics, 5G infrastructure all require silver, and that demand isn't slowing. Meanwhile, mine production in 2024 was 820 million ounces, up less than 1% from 2023. The silver market has been in structural deficit for at least 4 consecutive years. That means total demand exceeds total supply, and the gap gets filled by drawing down above-ground inventories. The Silver Institute estimates the 2024 deficit at approximately 149 million ounces. From 2021 through 2024, the cumulative deficit reached 678 million ounces. That's equal to 10 months of global mine production. Where did those 678 million ounces come from? Existing stockpiles got drawn down, and who's been accumulating during this period? JPMorgan. While inventories globally were being depleted, JPMorgan was pulling metal into their vaults. Now here's where the mechanics become critical. COMEX operates on fractionally reserved basis. According to recent data, open interest, meaning total outstanding futures contracts, represents approximately 244% of vaulted silver. For every ounce of physical silver in COMEX vaults, there are about 2.4 ounces worth of paper claims. What happens if significant numbers of contract holders demand physical delivery? The system faces stress, prices spike, and the entities holding physical metal control an increasingly scarce asset. On November 28, 2025, something highlighted this fragility. The CME group experienced a data center outage lasting over 10 hours. Official reason given was a cooling system failure. During that outage, silver spiked to $56.72. When trading resumed, bid-ask spreads had widened to over $1. That's illiquidity. That's a market under stress. And in the aftermath, according to COMEX filings, JPMorgan reclassified approximately 13.4 million ounces from registered to eligible status. They pulled deliverable silver off the table right when the market was already tight. Think about the positioning. JPMorgan accumulated for 14 years, starting when silver was $15 to $30. They accumulated through the manipulation scandal and settlement. They continue to hold as prices reach all-time highs above $61, and they're reducing deliverable supply when physical demand is surging. This is not random trading. This is strategic positioning that's been sustained over 14 years through multiple market cycles, through regulatory challenges, continuing to the present day. Let's look at the supply fundamentals, because this is where the story becomes structural. About 70% of silver supply comes as a byproduct of mining other metals like zinc, lead, and copper. That means silver production is largely determined by demand for base metals. If copper demand is weak, copper mines slow down, and silver supply as a byproduct also slows. Primary silver mines account for only about 20% of supply. Many face challenges like declining ore grades, rising energy costs, and permitting delays. Major producers have reported production challenges. On the recycling side, only about 18% of silver used in electronics gets recovered. Solar panels lock silver away for 25 to 30 years. So recycling adds only about 194 million ounces annually. Total supply in 2024, including mining and recycling, was roughly 1.01 billion ounces. Total demand was 1.16 billion ounces. The deficit, 149 million ounces. After 4 consecutive years of deficits totaling 678 million ounces, above-ground inventories are significantly lower. In this environment, entities holding large physical positions are structurally advantaged. As available supply tightens, as deficits continue, As industrial users compete with investors for limited metal, prices face upward pressure. And JPMorgan, having accumulated for 14 years, sits on what may be the single largest concentrated position in physical silver globally. So what does this signal? At minimum, one of the world's most sophisticated financial institutions believes physical silver is worth holding in massive quantities. They've committed capital, vault space, and strategy to accumulating this position. They've held through multiple price cycles, through regulatory scrutiny, through criminal charges against their traders. That level of conviction, sustained over 14 years, suggests this isn't short-term trading. This is strategic accumulation with a long-term thesis. Most likely, the thesis is that physical silver becomes increasingly valuable as industrial demand grows, as green energy adoption accelerates, as supply struggles to keep pace. Or possibly, the thesis is that the paper silver market becomes unsustainable. If leverage ratios continue rising, if more holders demand physical delivery, if trust in paper contracts erodes, then physical metal becomes the only real claim on value. Either way, JPMorgan's actions speak to clear conviction that physical silver has substantial value, now or in the future. What we know is documented. JPMorgan opened their COMEX vault in 2011. They've been the largest stopper of delivery contracts for years. They currently hold approximately 169 million ounces in COMEX vaults. They serve as custodian for SLV's 103 million ounces. Broader analyst estimates suggest total holdings between 675 million and over 1 billion ounces. What we can observe is behavior, sustained, systematic, large-scale accumulation of physical silver over 14 years, through multiple market cycles, through regulatory challenges, continuing to present day. If you're analyzing silver markets, you cannot ignore that one bank potentially controls 9% of global above-ground supply. As deficits continue, as COMEX inventories remain tight, as industrial demand hits records, the entities holding large physical stockpiles are positioned accordingly. This isn't financial advice. This is observation of documented behavior and publicly available data. But the pattern is clear. One bank, massive accumulation, tight markets, rising prices, and structural deficits that show no signs of ending. JPMorgan's silver accumulation, whether it's 675 million ounces or over 1 billion, represents approximately 9% or more of global supply. That's gone from the open market, locked in vaults. And in a market where every ounce counts, where deficits add up year after year, where industrial demand keeps setting records, that concentration matters. From zero silver vault presence in 2011 to potentially the largest physical silver position in modern history. That's not casual investment, that's strategy. And whatever JPMorgan sees in silver's future, they've been positioning for it systematically since March 2011. The accumulation continues, the deficits continue. And as silver trades above $61, with markets showing increasing signs of physical scarcity, the story of what happens next is just beginning.